Imagine I started a business buying and selling mangoes. So it's a very simple business. I'm a sole proprietor in this business. I simply go get these mangoes from some tree, or I actually could even be buying these mangoes from some suppliers from the village. I bring these mangoes to the city and sell them. Now, how do I measure my performance? How do I know that I am making a profit or I'm making a loss? It's very simple. It's no brainer. I'm simply going to get the amount of sales that I've made, and I will deduct how much I incurred in buying the mangoes. The difference is the profit. So I'm able to know whether I'm making a profit or a loss. Now, let's imagine that my business begins to grow. So when it begins to grow, it means that I am now no longer selling these mangoes along the roadside. Now I do have a room that I have rented, and I specifically sell mangoes in a very big room. So I'm growing. Yes, the volume of transactions has increased, but I am still a sole proprietor. I am still able to handle my bookkeeping. So I am still able to measure my performance by myself. But of course, I can only do that for up to so far. Yes, I'm going to start recruiting new people to come into the business, to come and start helping me with handling the sales and other aspects of the business. So as the business keeps growing, it means there are more moving parts to control, or more moving parts to monitor as far as the business is concerned. So definitely it's going to reach a point where I'm going to have to hire an accountant to deal with the books, because the business has probably expanded to beyond the physical location where I started. Now it's maybe 10 branches countrywide. So there are 10 branches countrywide. I have an accounting team, a finance team that is responsible for measuring the performance of the business on a day-to-day, on a month-to-month, on a regular basis. So now let's assume that this business has become so explosive, it is rapidly increasing, and it needs to go overseas. I need to start setting up branches in Kenya, in the neighboring countries, but it's going to require a significant amount of capital to do so. Or maybe I need to shift from just selling mangoes to now I need to process these mangoes into a finished product, that like, a mango juice or something. And this is going to require a significant amount of investment. So because it's going to require a significant amount of investment, it means that I'm supposed to go approach potential people that could give me the money. It could be the bank, it could be angel investors. They have the money and they are just looking for opportunities to invest this money with hope that this money will return profit. Now let's assume, okay, now here it is. I have this business where I buy and sell mangoes. It is doing well for me. It has expanded to various locations in the country, and now I would like to pivot this into, creating an agricultural processing industry where I get these mangoes, and these mangoes are used as raw material to produce mango juice as a finished product. So what do? I approach some investors. These are people that are there with a lot of redundant money that they are looking for opportunities to invest this money. So I go and I start telling them this story about how good my business is, how they need to invest money in my business, how they will be getting the returns and all these things. Of course, as I am telling them these stories about how good my business is, I need to back it up with proof. And the way to back this up with proof is to use my financial statements. I have been running this business over some time, and I've been creating financial statements. Financial statements kind of like tell a story about how the business is performing and also about the position of the business. It tells the financial position and the financial performance of the business. And so if I give these financial statements to these investors or to the bank, they are going to look at these financial statements, and they are going to use them as basis to determine whether they should invest in this business or not. Now, normally, it is not always going to be the case that these investors are they are only receiving requests only from you. They are probably receiving requests from a lot of other entities that require them to invest money. And what criteria are they going to use to determine which business to invest in and which one not to invest in? Well, definitely they are going to based on what the story that is being told by the financial statements. So if the financial statements are going to be basis to make a decision as key as where I should invest or where an investor needs to invest billions of money, then these financial statements better be telling the truth. They better be telling a robust story about the performance. So as a business person, I could choose to, create my financial statements and manipulate the figures to create a rosier picture or to create a more favorable picture about the actual performance of the entity, my mango selling business. And if that is what I resort to doing, it means I am misrepresenting the facts about my business. And that would mean that the person that will take a decision to invest with me based on these financial statements that have been manipulated will be making a decision based off a lie. Now, it might not be even just manipulations. Let's say I have prepared financial statements and from my business, and I am preparing them basing on, the methods on how we arrive at these figures. I am using these methods that I just think them up. No standards. Maybe another business person also wants funding. They have also prepared their own financial statements, but the methods they used to come up with those financial statements, they are subjective. They just thought what price should we give to this asset? How should we recognize this? In other words, if there were no standards in regards to how we come up with the figures that we declare in the financial statements, it would mean that these financial statements cannot be compared. This is what I mean. If there are 5 businesses that are looking for funding, and all these 5 businesses have financial statements they are presenting to communicate their performance, it is important that we probe into how these financial statements were prepared. What are the criteria that were used in recognizing an asset, in measuring an asset? Is it the same across the board? If we are saying that all these are financial statements of 5 companies, and in these financial statements there is something we call an expense, what criteria was used to recognize that this is an expense? What criteria were used to recognize that, to measure these expenses, in other words, or this asset, or these liabilities? So these criteria that was used in order for us to be able to adequately compare the performances of these 5 businesses that are looking for funding, it is prudent that the methods or the approach towards how the elements in these financial statements were arrived at is consistent. Now, before 1973, there were no accounting standards. Every company had its own accountant, and when they were preparing financial statements, they used to prepare these financial statements the way they deemed fit. Accountant in this organization creates financial statements the way they deem fit. By the way they deem fit, I mean an example. Let's say I could get 3 different accountants. They come and they prepare financial statements for my business. And the 3 different accountants, each one will come up with financial statements, And these financial statements are going to communicate something different. In other words, the financial statements are not going to be the same. That's what I'm trying to say. It is one business, it's the same business. There are 3 different accountants, but they are all producing financial statements, and the financial statements each accountant has produced is different. They are giving a different picture. That is what used to happen before 1973. And it used to be so because during that time there were no standards. Everyone had their own way of recognizing what an asset is, what a liability is, what an expense is, what income is. When it comes to different scenarios in accounting, like how do we handle depreciation, how do we handle debtors, everyone, it was all subjective. There were no standards. And so because people applied different methods or different approaches to handling different scenarios in accounting when they are constructing the financial statements, you'll find that different accountants would produce different financial statements for the same entity. And because of that, it becomes hard to compare. If it is an investor and you want to invest money you want to choose where you should put your money, and there are 5 financial statements before you, it becomes hard for you to really rely on these financial statements. Why? Because they've been prepared differently, so you can't compare adequately. In other words, the integrity of these financial statements is in question as a result, because 1, there were no standards then, and because there were no uniform standards across the board, then the other issue of manipulation comes in. Somebody could easily manipulate the figures to suit their narrative. So to do away with this kind of subjectivity, and in a bid to try and create, sanity or uniformity across the board, in accounting in 1973, that's when we have the International Accounting Standards Committee coming up. It was formed. It was a body that came to try to put uniformity in the accounting profession. Okay? And by uniformity, we are talking about a certain set of rules and regulations that govern how we prepare financial statements. And so this International Accounting Standards Committee, which was established in 1973, then it started coming up with what we call the International Accounting Standards, which you're calling the IAS. So in other words, we have what we they were called IASs, IAS 1, IAS 2, IAS 3. All these IASs, or call them the International Accounting Standards, were simply rules and guidelines that are addressing something specific in regards to how we prepare financial statements. So this organization, the International Accounting Standards Committee, continued in operation up to around 2001. So in 2001, there was a major restructuring to this organization, and it brought about the birth of the International Accounting Standards Board. So the International Accounting Standards Board replaced the International Accounting Standards Committee. So the International Accounting Standards Committee used to produce standards that we call the International Accounting Standards, or short form is IAS. Then the International Accounting Standards Board, which came into force in 2001 up to date, it now produces international accounting standards that we call the International Financial Reporting Standards, which we call the IFRS. So most of these changes are more of cosmetic, because before it was the International Accounting Standards Committee, which just changed its name when there was a restructuring into what we call the International Accounting Standards Board. Then previously, the standards that were produced were called International Accounting Standards, which just simply changed form and were being called International Financial Reporting Standards. So now, what used to happen before the IAS, International Accounting Standards, Some of those standards are still in effect up to today, and they are called just IAS, maybe IAS 1, IAS 2, whatever. Now, when the restructuring happened in 2001 and the International Accounting Standards Board was created, the standards that were produced from then moving forward are called IFRS. So whenever a new standard is created, it's called IFRS. In other words, same thing, IFRS 1, IFRS 2, IFRS 3, those accounting standards, yes. So did this mean that the accounting standards before were done away with, that is the IAS, International Accounting Standards? No, they were not done away with. They are still maintained. But in case there was need for an amendment of an old standard that was produced in the IAS era, when it is amended or revised, it is not called, they do not transform its name into IFRS, but rather they just call it IAS revised. So let's say something came up and they said they wanted to revise an IAS. They won't change it to IFRS, but it will just be called IAS revised. So in other words, the current International Accounting Standards Board issues new standards that it calls IFRS, and in case they need to amend an old one, they don't change its name, they just call it IAS revised. So these accounting standards, like I had mentioned earlier, are simply rules that govern how accountants create financial statements. But now, as these rules are being made, they are supposed to be a guiding light on how we make these rules. I'll give an example. Let's talk about construction. Okay. When we are constructing a house, for example, like the house I am in right now, it is a house that is probably going to stay here very strong. You know, when these engineers are making this house, they're making sure that it is strong. Maybe it's supposed to be weather resistant, meaning that whatever kind of, weather conditions that come, at least it must be able to resist some level of wind, some amount of rain. It should stay standing if a storm came. So when the engineers are trying to design the houses, they're supposed to make sure that the house is strong and it's able to have the qualities of a very strong house. So the concept here is that the house has to be strong. It has to be durable. Those are the concepts. So now the issue is now, how do these engineers implement those concepts in the construction phase? They are going to implement those concepts by making sure, by putting a rule that every time you mix 2 wheelbarrows of sand, every time you mix 3 wheelbarrows of sand, put 2 bags of cement. That is, I'm just giving an example. So the rule of mix 3 wheelbarrows of sand with 2 bags of cement, that ratio is a rule that is now created during construction. That this is the rule, this is how you do it. But that rule that was created during construction, it is created to foster a certain idea, to foster a certain concept, to promote a certain concept. And what concept is it trying to promote? It is trying to promote the concept that the house has to be strong, the house has to be durable, the house has to be weather resistant. So in order for us to foster the idea that the structure needs to be strong, these are the rules. When we are mixing sand and cement, it is supposed to be in this ratio. That's the rule. When we are trying to make scaffolds, building the bricks, we're supposed to arrange them in this structure to enable that maybe the load-bearing capacity, whatever. You get the idea. So it's the same thing with accounting. Yes, the International Accounting Standards Board comes up with rules of this is how you should recognize an asset. This is how you should recognize a liability. This is how you should depreciate an asset. This is how you should measure an asset. This is how you should handle this in this scenario. Let's say you're presented with, let's say it's a company and it is earning income from abroad, or it is having branches abroad. When you're preparing financial statements for this one, this is how you should handle it. In other words, the International Accounting Standards Board gives those rules, and those are the rules that we have been mentioning: the IAS 1 or the IFRS 1, IFRS 2, IFRS 3. But now when it is creating these rules, it does so with a set of underlying principles. Just like the way I said in construction that the underlying principle or the theory is that the house has to be strong, even in accounting we have underlying principles that guide the rules, or that the rules foster. So all the accounting standards that you will be learning about later on, there are underlying principles behind them that foster them. So these underlying principles, these underlying theories that help create the rules are theories that have been around for more than 100 years. And there have been attempts to get these principles into a wider framework. And now this is what we are calling the conceptual framework in accounting. So the conceptual framework in accounting, it is more like it is a theoretical framework that seeks to try and help the International Accounting Standards Board to set these rules. So in other words, these rules are there, and in crafting these rules, the guidance was premised on some ideas in the background, and these ideas are the conceptual framework of accounting, the ideas behind the rules that we follow in accounting. So in our next sessions, we are going to delve deep. I'm going to be explaining these underlying principles and the concepts. So in today's session, I was simply just trying to give you an overview on how this conceptual framework actually comes. Just trying to explain what exactly the conceptual framework is. So now that I've explained what the conceptual framework is, so we are going to now start looking at those underlying concepts that formulate the conceptual framework of accounting. My name is Arnold. This is Kisembo Academy.